In the tapestry of modern life, insurance plays an often overlooked but crucial role. It provides a safety net, a shield against the unexpected turns of fate. From the mundane to the catastrophic, insurance safeguards our homes, our health, our businesses, and our very lives. Businesses, large and small, rely on insurance to manage risk and foster growth. Individuals depend on insurance to protect their assets, their families, and their futures. The insurance industry is a vast and complex ecosystem, but at its core, insurance is about one thing: managing risk. Risk is an inherent part of life. It is the possibility of loss or damage, the ever-present threat that lurks beneath the surface of our daily existence. From the moment we wake up to the moment we close our eyes, we are exposed to countless risks. Throughout history, humans have grappled with the challenge of managing risk. We have devised ingenious ways to mitigate, transfer, and even profit from risk. Insurance is perhaps the most successful risk management tool ever invented.
The roots of insurance can be traced back to ancient civilizations. Long before modern insurance companies, people sought ways to protect themselves from life's uncertainties. They formed guilds, pooled resources, and developed informal agreements to share the burden of loss. In ancient Mesopotamia, traders developed a system of bottomry to mitigate the risks of maritime commerce. Bottomry was an early form of marine insurance, in which a merchant would borrow money to finance a voyage. If the ship was lost at sea, the loan would be forgiven.
In the Fertile Crescent of Mesopotamia, civilization took root. This land, now modern-day Iraq and Kuwait, witnessed the rise of bustling cities, intricate trade networks, and remarkable advancements in writing, mathematics, and law. The people of Mesopotamia faced dangers both familiar and unique. Floods, droughts, and storms threatened their crops and livelihoods. Banditry and warfare posed constant threats to their caravans and storehouses. These ancient innovators were not merely reacting to misfortune, but actively seeking ways to anticipate and manage it. This proactive approach to risk laid the groundwork for the sophisticated insurance mechanisms we see today.
The lifeblood of Mesopotamia was trade. Merchants traversed vast distances, their caravans laden with textiles, pottery, and precious metals. These journeys, while lucrative, were fraught with peril.
To protect themselves, Mesopotamian merchants developed innovative practices that foreshadowed modern insurance principles. One such practice was the use of contracts and agreements to share risk among multiple parties.
These contracts often involved a third party, typically a wealthy individual or temple, who would act as a guarantor. This system of risk transfer, known as suretyship, provided a crucial safety net for merchants.
The Code of Hammurabi, one of the earliest known legal codes, offers a fascinating glimpse into the legal framework of ancient Babylon. This code, inscribed on a towering stele, covered a wide range of issues, including trade, property rights, and personal injury. Embedded within its 282 laws are principles that resonate with modern insurance concepts. The Code of Hammurabi established clear guidelines for assigning responsibility for damages or losses. This emphasis on accountability and compensation provided a framework for managing risk and ensuring fairness in commercial transactions. As Mesopotamian trade expanded, so too did the need for mechanisms to mitigate the risks associated with maritime ventures. Babylonian merchants, renowned for their seafaring prowess, developed a system known as bottomry, a precursor to modern marine insurance. Bottomry was a type of loan agreement that helped merchants finance their voyages and spread the risk of maritime perils. Under a bottomry contract, a merchant would borrow money for a voyage using their ship or cargo as collateral. If the voyage was successful, the merchant repaid the loan with interest. However, if the ship was lost at sea due to storms, pirates, or other perils, the loan was forgiven.
As the sun rose over the Aegean Sea, casting a golden glow upon its sapphire waters, it illuminated a world teeming with life and commerce. Ancient Greece, a mosaic of city-states scattered across islands and peninsulas, was bound together by the sea.
Ships, propelled by wind and oar, carried not only goods but also ideas, culture, and the seeds of innovation. For the ancient Greeks, the sea was both a lifeline and a source of constant peril.
Navigating these treacherous waters demanded not only seafaring skill, but also a keen understanding of risk management. Drawing upon earlier Mesopotamian practices, they refined and expanded the concept of marine insurance. The ancient Greeks inherited the concept of bottomry from their Mesopotamian predecessors, but they didn't simply adopt it wholesale.
Greek merchants, sailing vast distances across the Mediterranean and beyond, faced unique risks that demanded innovative insurance solutions. One key refinement was the development of respondentia, a form of marine insurance that focused specifically on the cargo rather than the ship itself.
Under a respondentia contract, a merchant could secure a loan against the value of their cargo, with the loan being repaid with interest only if the goods arrived safely at their destination. This distinction between bottomry and respondentia allowed for greater flexibility and risk management.
This nuanced approach to marine insurance reflected the Greeks' deep understanding of risk. Athens, with its powerful navy and strategic location, emerged as a dominant force in the ancient Greek world. Its port, Piraeus, bustled with ships from distant lands bringing grain, timber, precious metals and slaves. Athenian merchants, recognizing the importance of protecting their investments, embraced marine insurance with particular enthusiasm. The bustling marketplace of Piraeus became a hub not only for the exchange of goods, but also for the negotiation of bottomry and respondentia contracts. Skilled scribes, fluent in the intricacies of maritime law, drafted contracts that stipulated the terms of risk-sharing in meticulous detail. The Athenian legal system provided a robust framework for enforcing these insurance contracts. From Piraeus to Ostia Marine Insurance in the Roman Republic. As the Roman Republic expanded its reach across the Mediterranean, it inherited not only Greek territories but also their sophisticated systems of trade and finance. Roman merchants, eager to tap into the lucrative trade routes established by their Greek predecessors, quickly recognized the value of marine insurance. Bottomry and respondentia contracts, once confined to the Aegean and Ionian seas, became commonplace in the bustling ports of the Roman world. Ostia, located at the mouth of the Tiber River, served as the gateway to Rome, channeling a constant flow of goods from every corner of the empire. With such high stakes, the need for reliable insurance mechanisms was paramount. Roman merchants, like their Greek counterparts, relied on bottomry and respondentia to mitigate the risks of maritime trade. Roman law and the formalization of insurance practices. Roman law, a cornerstone of Western legal tradition, played a pivotal role in shaping the development of insurance. Roman jurists, drawing upon centuries of legal precedent and philosophical debate, recognized the importance of contract law in regulating commercial transactions, including those involving risk transfer. Their insights, codified in legal texts like the Digest of Justinian, provided a robust framework for the enforcement of insurance contracts. The concept of bona fide or good faith was central to Roman contract law. Both parties to a contract, including insurance agreements, were expected to act honestly and transparently. This principle helped to prevent fraud and abuse, fostering trust between insurers and insured parties. The fall of Rome, the rise of communities, the once mighty Roman Empire, weakened by internal strife and external pressures, crumbled under its own weight. As the centralized authority of Rome waned, so too did the sophisticated legal and economic systems that had sustained its vast trade networks. In the ensuing vacuum, new forms of social and economic organization emerged, driven by the need for security and cooperation in a world beset by uncertainty. Out of this crucible of change emerged guilds, fraternal organizations that would play a pivotal role in shaping the medieval social fabric and laying the groundwork for modern insurance principles.
Guilds, born out of necessity and nurtured by a spirit of fraternity, became a defining feature of medieval life. These associations, typically organised around specific trades or crafts, provided a framework for mutual support, skill development and economic advancement.
At the heart of the guild system lay the principle of mutual aid. Guild members, bound by oaths of loyalty and shared values, contributed to a common fund, pooling their resources to create a safety net for those facing hardship.
These early forms of mutual aid, while rudimentary compared to modern insurance policies, embodied the essential elements of risk-sharing and collective responsibility. Their legacy can be seen in the countless mutual aid societies, fraternal organisations, and cooperative ventures that continue to thrive in communities around the world.
The concept of mutual aid, deeply rooted in human history, found fertile ground in the medieval world. Beyond the confines of guilds, communities developed a wide array of informal arrangements to provide support and assistance to those in need. These practices, often driven by religious beliefs or communal solidarity, reflected a shared understanding that individual well-being was inextricably linked to the well-being of the community as a whole. In rural villages, neighbours helped neighbours, sharing labour during harvest time, assisting with the construction of homes and caring for the sick and elderly. Religious institutions, too, played a crucial role in providing social welfare, offering food, shelter and medical care to the poor and destitute. As the medieval period progressed and trade routes reopened, connecting distant regions and fueling economic growth, guilds evolved to meet the changing needs of society. While initially dominated by craftsmen and artisans, guilds expanded their membership to include merchants, traders, and other professionals involved in the burgeoning world of commerce. This diversification brought new challenges and opportunities, leading to further innovation in the realm of risk management. Merchants, facing the perils of long-distance trade, sought ways to protect their investments from piracy, shipwreck, and other hazards. Drawing upon the principles of mutual aid that had long governed their craft-based counterparts, merchant guilds developed sophisticated systems of risk-sharing and insurance. These merchant guilds, often organized along specific trade routes or geographic regions, pooled resources to create insurance funds. Members contributed to these funds, and in the event of loss, such as a ship sinking or a caravan being robbed, the guild compensated the affected merchant, spreading the risk among its members. The Hanseatic League, a maritime alliance, and its shared protection. In the turbulent waters of the North and Baltic Seas, a powerful maritime alliance emerged, the Hanseatic League. This confederation of merchant guilds, spanning over 100 cities and towns, dominated trade in Northern Europe for centuries, wielding economic and political influence that extended far beyond its maritime roots. The Hanseatic League's success was due in no small part to its innovative approach to risk management, which included sophisticated forms of mutual insurance. Recognizing the inherent dangers of seafaring, Hanseatic merchants established a system of shared protection that mitigated the risks of piracy, shipwreck, and other maritime perils. Ships sailing under the Hanseatic flag often traveled in convoys, guarded by armed escorts and equipped with cannons and other defensive measures. This collective defense strategy, funded by contributions from member guilds, reduced the likelihood of attack and minimized losses. Beyond collective defense, the Hanseatic League developed sophisticated insurance mechanisms to compensate merchants for losses. These insurance schemes, funded by contributions from member guilds, provided financial assistance to merchants who suffered losses due to shipwreck, piracy, or other unforeseen events. Beyond Europe, mutual aid societies in the East. While guilds and mutual aid societies flourished in Europe, similar institutions emerged independently in other parts of the world, driven by the same fundamental human need for security and cooperation. In Asia, Africa, and the Americas, communities developed a wide array of social structures and practices designed to provide support and assistance to those facing hardship. In China, for example, clan associations and lineage groups played a crucial role in providing social welfare. These kinship-based organizations maintained communal funds to assist members with medical expenses, funeral costs, and other essential needs. Similarly, in India, caste-based organizations and village councils often provided mutual aid to their members, reflecting a deeply ingrained sense of social responsibility. These examples highlight the universality of mutual aid as a social mechanism for managing risk and promoting well-being. Regardless of cultural or geographic context, humans have consistently sought ways to create safety nets within their communities, recognizing that collective action can mitigate the uncertainties of life and foster a greater sense of shared prosperity. A legacy of cooperation from medieval guilds to modern mutuals. The legacy of medieval guilds and mutual aid societies extends far beyond the cobblestone streets and bustling marketplaces of the Middle Ages. The principles of collective responsibility, risk-sharing, and mutual support that animated these early institutions continue to shape the landscape of insurance and social welfare in the modern world. From fraternal organizations and credit unions to cooperative businesses and mutual insurance companies, the spirit of cooperation that characterized medieval guilds lives on. These modern-day incarnations of mutual aid embody the enduring human desire to create systems of support that prioritize collective well-being over individual gain. Mutual insurance companies, in particular, stand as a testament to the enduring legacy of medieval guilds. Owned by their policyholders rather than by shareholders, mutual insurance companies prioritize the interests of their members, focusing on risk management and long-term stability rather than short-term profits. This member-centric approach, rooted in the principles of mutual aid, has made mutual insurance a popular choice for individuals and businesses seeking reliable and affordable insurance coverage. The 17th century in England was an era marked by profound transformation. The Renaissance had swept across Europe, igniting a thirst for knowledge, exploration, and innovation. England, under the reign of the Stuart monarchs, experienced a period of economic expansion, driven by burgeoning trade and colonial ventures. Yet this era of progress was also a time of turbulence and uncertainty. Religious and political conflicts roiled the nation, culminating in the English Civil War and the execution of King Charles I. The plague, a recurring scourge throughout history, cast a long shadow over the land, claiming countless lives and disrupting commerce.
It was against this backdrop of change and upheaval that a momentous event would forever alter the course of insurance history, the Great Fire of London. This catastrophic fire, which consumed vast swaths of the city, not only left a trail of physical destruction, but also exposed the inadequacy of existing mechanisms for coping with such widespread losses.
From the ashes of this disaster would rise a new industry, one that would revolutionize risk management and lay the foundation for modern insurance as we know it today. In the heart of London, in the crowded, timber-framed buildings that lined Pudding Lane, a spark ignited in the early hours of September 2nd, 1666. The fire, fueled by dry summer winds and the close proximity of flammable materials, quickly spread, engulfing homes, shops and warehouses in its path. What began as a localized blaze quickly transformed into an inferno, consuming everything in its wake. For days, the fire raged, turning the London skyline into a sea of flames. Efforts to contain the blaze proved futile, hampered by narrow streets, inadequate firefighting equipment, and the sheer scale of the conflagration. The firestorm swept through the city, leaving a trail of devastation in its wake. By the time the fire was finally extinguished on September 5th, an estimated 13,200 houses, 87 churches, and countless other structures lay in ruins. Over 70,000 people, representing more than 2/3 of the city's population, were left homeless. The Great Fire of London, one of the most destructive urban fires in history, had reshaped the city both physically and psychologically. The Great Fire of London, while tragic, catalyzed profound change. Londoners, surveying the ruins, realized the need for protection. Entrepreneurs saw an opportunity amidst the chaos. This marked the birth of modern insurance.
Among the entrepreneurs who recognized the need for a new approach to risk management in the wake of the Great Fire was Nicholas Barban, a physician turned property developer. Barban, a shrewd businessman with a keen eye for opportunity, saw the potential for creating a new market for fire insurance. In 1667, just a year after the fire, he established the first fire insurance office in London, the Insurance Office for Houses.
Barban's insurance scheme was simple yet revolutionary. For a small annual premium, homeowners could insure their properties against the risk of fire. In the event of a fire, the insurance office would compensate the homeowner for their losses up to the insured amount. This system provided homeowners with a measure of financial security, allowing them to rebuild their lives without facing financial ruin.
Barban's insurance office, while initially met with skepticism, quickly gained popularity. The memory of the Great Fire was fresh in people's minds, and the prospect of protecting their hard-earned investments from a similar fate proved appealing. Barban's success inspired imitators, and within a few years, numerous other fire insurance offices sprung up in London, competing for business and refining the principles of fire insurance.
The emergence of fire insurance in the wake of the Great Fire of London sparked a wave of entrepreneurial activity. New insurance offices, eager to capitalize on this burgeoning market, established themselves in London and other major cities. Competition was fierce, driving innovation and leading to the development of new insurance products and practices. Early fire insurance policies were often rudimentary, covering only the basic structure of a building and lacking standardized terms and conditions. However, as the industry matured, insurance policies became more sophisticated, offering coverage for a wider range of perils, including theft, lightning strikes, and even riots. Insurance companies also began to develop more sophisticated methods for assessing risk and setting premiums, relying on actuarial science and statistical analysis. The growth of the insurance industry was not without its challenges. Fraudulent claims, inadequate capital reserves, and the unpredictable nature of risk posed constant threats to the stability of insurance companies. However, the industry as a whole proved resilient, adapting to changing circumstances and developing new strategies for managing risk. The stage was set for the emergence of large, stable insurance institutions that would play a pivotal role in the global economy.
While fire insurance was taking root in London, another strand of the insurance industry was developing in the maritime world. Edward Lloyd's Coffee House became a gathering place for merchants, ship owners and underwriters.
Established in 1688, it was a hub of information about shipping and trade. Here, the foundations of modern marine insurance were laid.
Merchants would write the details of their ventures on slips of paper. These slips would be circulated among underwriters willing to assume a portion of the risk.
Lloyd's of London, from coffee to global insurance powerhouse. Edward Lloyd's Coffee House evolved into one of the most influential institutions in insurance. As maritime trade grew, so did the demand for marine insurance. Lloyd's became the go-to destination for merchants seeking to protect their investments. In 1771, Lloyd's formalized their association, establishing a society of underwriters. Lloyd's operated as a marketplace, bringing together those seeking insurance with providers. This unique structure allowed Lloyd's to insure a wide range of ventures. Lloyd's expanded its reach, becoming a global leader in insurance and reinsurance. The spread of insurance from London to the world, the seeds of modern insurance sown in the aftermath of the Great Fire of London and nurtured in the coffee houses of the city's bustling port, spread rapidly across the globe as trade expanded, connecting distant continents and fueling economic growth. So too did the need for insurance to mitigate the risks of commerce and enterprise. Insurance companies, modelled after those that had emerged in London, established themselves in major cities across Europe and North America. From Amsterdam to Paris, from Boston to Philadelphia, the principles of risk-sharing and financial protection took root, adapting to local customs and regulations. The spread of insurance was not merely a matter of replicating existing models. As insurance reached new shores, it encountered unique challenges and opportunities, prompting further innovation and adaptation. The principles of insurance, once confined to the realm of maritime trade and fire protection, were applied to a growing array of risks, from agricultural losses to life expectancy, laying the groundwork for the diverse and sophisticated insurance industry we know today. A new era. Dawns, the Industrial Revolution reshapes the world. The 18th century drew to a close, and with it, a new chapter in human history began. The Industrial Revolution, a period of unprecedented technological innovation and societal transformation, swept across Europe and North America, forever altering the landscape of human endeavour. From the depths of coal mines to the towering smokestacks of factories, a new world was being forged, one powered by steam, iron, and the ingenuity of humankind. The clatter of mechanized looms replaced the rhythmic hum of hand looms. The roar of steam engines echoed through valleys once silent but for the murmur of nature. Cities swelled with people seeking opportunity, drawn by the promise of work and a better life. The world was in flux, a dynamic, ever-shifting landscape of progress and peril. This era of unprecedented change brought with it a new set of challenges and risks, demanding innovative solutions to protect individuals, businesses, and society as a whole. The insurance industry, already evolving to meet the demands of a changing world, found itself at the forefront of this transformation, adapting its practices and developing new products to manage the risks of an increasingly industrialized society. The rise of the machine's new risks emerge. The factory floor, a symbol of progress, also presented new risks. Machines posed inherent dangers to operators. Gears could crush limbs in an instant. Belts posed entanglement hazards. Boilers held the potential for catastrophic explosions. The risks extended beyond factory walls. The factory floor, protecting workers in an age of industry. As factories multiplied across the industrial landscape, so too did the number of workers injured or killed on the job. The plight of injured workers, often left without compensation or means of support, became a growing concern, prompting calls for reform and the development of new mechanisms for protecting workers and their families. Early attempts to address workplace safety often faced resistance from factory owners who prioritized profits over worker well-being. However, as the human cost of industrial accidents became increasingly apparent, pressure mounted for government intervention and the establishment of legal frameworks for worker protection. In response to these pressures, governments began to enact legislation aimed at improving workplace safety and providing compensation for injured workers. These early workers' compensation laws, though limited in scope and application, marked a significant step towards recognizing the rights of workers and the responsibility of employers to provide a safe working environment. Urbanization and its perils, the rise of property insurance. The Industrial Revolution triggered a massive wave of urbanization. Cities swelled in size and density, crowded with newcomers. Rapid urbanization brought new challenges and risks. The Great Fire of London highlighted the risk of fire in dense urban areas. The insurance industry expanded to include comprehensive property insurance. These policies covered fire, theft, vandalism, and other urban risks. The dawn of motor insurance. Towards the end of the 19th century, the automobile emerged, revolutionizing transportation. Initially a novelty for the wealthy, automobiles promised speed and freedom, but with their rise came significant risks to drivers and pedestrians. Early cars lacked safety features and were prone to accidents. Accidents increased, prompting calls for regulation and insurance. The insurance industry created the first motor insurance policies. Shielding businesses from liability, the rise of a new insurance paradigm. The Industrial Revolution brought economic growth and awareness of business liabilities. Accidents and negligence led to financial losses and legal disputes. Businesses grew, increasing potential liabilities. The insurance industry developed liability insurance. Liability insurance provided financial protection for businesses. Life insurance evolves from burial societies to financial planning. Life insurance, with roots in ancient burial societies, underwent a significant transformation during the Industrial Revolution. While early forms of life insurance primarily focused on covering funeral expenses, the industrial age brought with it a new understanding of life insurance as a tool for financial planning and security. The rise of industrial capitalism, with its emphasis on individual achievement and social mobility, created a greater awareness of the financial risks associated with death, disability, and old age. Breadwinners, upon whose income families depended, faced the constant threat of illness, accidents, or premature death, leaving their loved ones vulnerable to financial hardship. In response to these concerns, life insurance companies developed new products and strategies, positioning life insurance not simply as a way to cover funeral costs, but as a means of providing financial security for families in the event of the breadwinner's death or disability. Life insurance policies became more sophisticated, offering a range of options, including whole life insurance, which provided lifelong coverage and accumulated cash value, and term life insurance, which offered affordable coverage for a specific period. Government steps in regulation and oversight shaped the industry. The rapid growth and diversification of the insurance industry during the Industrial Revolution brought with it a new set of challenges, prompting governments to take a more active role in regulating the industry to protect consumers and ensure market stability. Early insurance regulations often focused on addressing fraudulent practices, ensuring the financial solvency of insurance companies, and standardizing insurance contracts to protect consumers from unfair or deceptive terms. As the industry matured and the complexity of insurance products increased, governments established regulatory bodies tasked with overseeing the insurance sector, setting standards and enforcing compliance. The regulation of the insurance industry, while sometimes met with resistance from insurance companies, ultimately served to strengthen the industry and build public trust. Government oversight, by promoting transparency, accountability and fair competition, created a more stable and reliable insurance market, benefiting both consumers and the industry as a whole. Seeds of the future. The industrial age lays the groundwork for modern insurance. The Industrial Revolution transformed the insurance industry. Industrialization forced the industry to adapt and innovate. Risk management principles expanded beyond maritime trade and fire protection, covering workplace accidents and product liability, from automobile collisions to death and disability. Insurance evolved into an essential component of modern economies, providing financial security to individuals and businesses. The legacy of the Industrial Revolution in insurance is one of innovation and adaptation. A world rebuilt, a need renewed. The ashes of World War II settled, leaving behind a world scarred and weary, yet resolute in its determination to rebuild. From the rubble of bombed-out cities to the shattered economies of nations, a spirit of resilience and renewal took hold. The post-war era marked a turning point in human history, a time of profound social, economic and technological change. As nations picked themselves up, the need for security and stability became paramount. Insurance emerged as an essential tool for managing uncertainty and fostering economic growth. The stage was set for unprecedented innovation and expansion in the insurance industry. The post-war boom, prosperity, and the rise of consumerism. The post-war era witnessed an economic boom, particularly in the industrialized nations of the West. Factories, once dedicated to producing armaments, hummed with the production of consumer goods. The world entered an era of unprecedented prosperity, and with it a fundamental shift in consumer behavior. The rise of consumerism, fueled by rising incomes, readily available credit, and a burgeoning advertising industry, transformed the economic landscape. The corporation as insurer giants emerge on the global stage. The post-war economic boom, coupled with the increasing complexity of risk in a globalized world, led to a consolidation within the insurance industry. Small, often family-owned insurance companies, once dominant in local markets, found themselves outpaced by larger, more diversified competitors. The rise of the corporate insurer, with its vast resources, global reach, and ability to manage complex risks, transformed the industry landscape. Large insurance companies, many with roots dating back to the 19th century, expanded their operations through mergers, acquisitions, and international expansion. These insurance giants, with their vast reserves of capital and expertise in risk management, became major players in the global economy, underwriting risks across a wide range of industries and sectors. The emergence of these corporate insurers brought with it both benefits and challenges. On the one hand, their size and scale allowed them to spread risk more effectively, offer more competitive premiums, and invest in research and development of new insurance products and services. On the other hand, their dominance raised concerns about market concentration, potential conflicts of interest, and the need for robust regulation to ensure fair competition and consumer protection. Reinsurance, sharing risk on a global scale. As the insurance industry grappled with the challenges of managing increasingly complex and catastrophic risks, a specialized segment of the market emerged: reinsurance. Reinsurance, essentially insurance for insurance companies, allowed insurers to share a portion of their risk with other insurers, creating a global safety net for catastrophic losses. The concept of reinsurance, while not entirely new, gained new importance in the post-war era. The increasing frequency and severity of natural disasters, the emergence of new risks associated with technological advancements, and the globalization of business operations all contributed to the demand for reinsurance capacity. Reinsurance allowed insurance companies to take on larger and more complex risks than they could otherwise manage on their own. By spreading risk across a global network of reinsurers, individual insurance companies could mitigate the financial impact of catastrophic events, ensuring their solvency and their ability to pay claims. Reinsurance became an essential component of the global insurance industry, providing stability and capacity to the market and enabling insurers to provide coverage for even the most extreme risks. The guiding hand of regulation governments shaped the insurance landscape. The post-war era witnessed a significant expansion of government regulation in the insurance industry, driven by a desire to protect consumers, ensure market stability, and promote fair competition. Governments around the world recognized the importance of insurance in fostering economic growth and social well-being, but also the potential for abuse and instability within the industry. Insurance regulation took various forms, from the establishment of government agencies tasked with overseeing the industry to the enactment of laws and regulations governing insurance contracts, licensing requirements, and financial reserves. These regulations, while sometimes met with resistance from insurance companies, aim to create a more transparent, accountable, and consumer-friendly insurance market. Key areas of insurance regulation included consumer protection measures, such as requiring clear and concise policy language, prohibiting discriminatory pricing practices, and establishing mechanisms for resolving consumer complaints. Financial regulations, such as capital adequacy requirements and investment restrictions, aim to ensure the solvency of insurance companies and their ability to pay claims. Antitrust laws and regulations sought to prevent monopolies and promote fair competition within the industry. The seeds of transformation technology begins to reshape the industry. As the 20th century progressed, technology began to exert its transformative influence on the insurance industry. Computers automated tasks, improved efficiency, and laid the groundwork for a digital revolution. Early systems improved efficiency, reduced costs, and sped up processing. Actuaries used statistical models and simulations to assess risk and price policies. The seeds of digital transformation were sown, reshaping the insurance industry. The digital age reshaping risk. The dawn of the 21st century ushered in a digital revolution, transforming the way we live, work, and interact with the world around us. The insurance industry, once a bastion of tradition and paper-based processes, found itself at the forefront of this digital transformation, its operations and strategies reshaped by the ubiquitous nature of technology. The Internet, once a novelty, became an indispensable tool for communication, commerce, and information exchange. Insurance companies, recognizing the transformative potential of this new medium, established online presences, offering customers the convenience of purchasing policies, filing claims, and managing their accounts from the comfort of their homes. The rise of mobile technology further accelerated this digital transformation. Smartphones, with their powerful processors, ubiquitous connectivity, and intuitive interfaces, became extensions of ourselves, enabling us to access information, connect with others, and conduct business from virtually anywhere at any time. Insurance companies, recognizing the transformative potential of this new paradigm, developed mobile apps, empowering customers to manage their insurance needs with unprecedented ease and accessibility. The future of protection, navigating uncertainty. As technology continues its relentless march forward, the insurance industry stands poised on the brink of further transformation. Artificial intelligence, once the realm of science fiction, is rapidly becoming a reality, with the potential to revolutionize the way insurance companies assess risk, detect fraud, and interact with customers. AI-powered algorithms capable of analyzing vast datasets with superhuman speed and accuracy are being deployed to personalize insurance premiums, automate claims processing, and identify fraudulent activities. Chatbots, powered by natural language processing, are providing customers with instant answers to their questions, guiding them through complex processes and offering personalized recommendations. The insurance industry, built on the foundation of data analysis and risk assessment, is uniquely positioned to leverage the power of AI to improve its operations, enhance customer experiences, and develop innovative products and services. As AI technology continues to mature, its impact on the insurance industry is likely to be profound, reshaping the industry landscape and redefining the very nature of insurance itself. Insurance in a changing world, a legacy of resilience. The story of insurance is a testament to human ingenuity and our enduring quest to manage risk in an uncertain world. From ancient practices of risk-sharing to the sophisticated global industry of today, insurance has evolved alongside human civilization, adapting to changing needs, embracing new technologies, and providing a vital safety net for individuals, businesses, and societies, navigating the complexities of an ever-changing world. The challenges facing the insurance industry today are as complex and multifaceted as the world we live in. Climate change, geopolitical instability, cyber threats, and emerging technologies all present new and evolving risks, demanding innovative solutions and a willingness to adapt to a rapidly changing risk landscape. Yet, if history is any guide, the insurance industry will rise to meet these challenges, drawing upon its long legacy of resilience, innovation, and a deep understanding of risk. As we navigate the uncertainties of the 21st century, one thing remains certain. The need for insurance, in its various forms, will only become more pronounced as individuals, businesses, and societies seek ways to protect themselves from the unexpected and embrace the opportunities of a world in constant flux.